So today it's going to be our friend, right?
Exactly.
Exactly. All right. So in February, our goal was really to talk about home ownership, and so with home ownership, sometimes people just don't fit in that perfect little box, right? And so having some programs and some products that help borrowers get into the home in a good way, with low rates and low down payment options and out of the box thinking and creative financing. Those are the things that we have here at Southern Trust. So I was hoping this morning you and I could kind of wrap around some of the products that we have and give our agents some visibility into different ways that buyers can get into homes this spring. So we're going to
Absolutely.
start with maybe. Good. Here we go. So we have a program called STM Smart, and you were telling me about this program the other day, and I thought, oh wow, this is really cool. I wonder how many buyers out there don't realize that they could still get into a property even though they may be a musician or bartender. Different types of gigs out there, not just that typical own your own company type of borrower. So can you kind of talk about the STM Smart program and really who it would cater to?
Absolutely. So STM Smart offers a number of different ways to qualify. There's two different focuses, but we'll start with the self-employed, like you mentioned. So self-employed borrowers can qualify, depending on their scenario, all the way up to 90% from their loan amount to appraised value. And this is for those that are wanting to use their bank statements, business or personal, in lieu of using their tax returns to qualify. So maybe they haven't filed their 2024 tax returns yet, but if they can provide us their business or personal bank statements, 12 months or 24 months, depending on how they want to work the transaction, we can use those to qualify the self employed borrower and show that their income is stable and that it's going to be sufficient enough to repay the mortgage and be likely to continue by analyzing those bank statements. So it's really helpful for those that they haven't filed or they just don't want to produce their tax returns for any reason. They can use these bank statements as long as we can see the cash flow going into those bank statements and be able to identify that it is probably from their business or their personal accounts and it covers their ability to qualify.
When it is a self-employed or like a gig or somebody like that, like are we looking at it from a 24-month like look back to average those bank statements and the cash flow?
It is either 12 or 24 months, and it's just depending again on how much financing you want to get, your loan amount. So, based on your credit score, your loan amount, and then the loan to value percentage that you want to acquire, those are all factors in whether you use the 12 or 24 months. So, if our borrower comes in with a very high score, they want to do $1 million loan and they want to max out max financing, you may be looking at 24 months over 12 just because you're covering more risk, you're taking out more money versus someone that may be doing, a $500,000 loan amount. They're at like a 680 credit score. We would be looking at a 12 month. So it really just depends on your scenario, really.
That's really cool. Okay. So, I mean, if we had like a smart buyer that like, well, perhaps somebody else was trying to get them into a loan that they didn't fit and they weren't in that perfect bow. Do we have, like a funny like scenario that it worked for somebody that you're like, that is so cool.
Yeah, we actually had one yesterday. Matter of fact, I was talking to one of our loan officers, and this young man had bought multiple properties. He had stuff in an LLC, which we can also close in the LLC's name if that's how the borrowers want to close. We just have to have them actually sign, but the LLC can be the closing in the name of the LLC. But he had acquired multiple properties. He likes to buy them, and then he usually will buy like multiplexes, live in one of the units while he renovates the rest because he actually has a contractor's license. So while he's there on site, he wants to make sure everything's going well. He rents them out, and then he flips them and turns them into investment and buys his next property. So he rents out his primary, uses this as his current primary, and then moves on to the next and the next, just acquiring more and more collateral in his portfolio. And it worked out very well because every other lender he had gone to said they couldn't make the income work. Our income specialist looked at his income, was able to maximize all of the income coming from his statements, and then use that to qualify and purchase his next investment.
That is so cool. Okay, awesome. All right, so let's talk about the Edge, STM Edge. This is also a really neat one. I feel like, a lot of times people, they get down and out when situations happen. It doesn't. Sometimes life just kind of throws you, a curveball, and we have a program that allows for those curveballs to become a home run, right? So can you
Absolutely.
talk about the STM Edge and who that benefits, and what kind of how can an agent use this to their advantage too?
So STM Edge, you see full doc there. So just to kind of elaborate on that, that can be anything from W-2s, tax returns, bank statements. It's all encompassing. We're looking at all the income, but there's a feature of asset qualifier, which allows high net worth borrowers to use their assets in lieu of income. So they can use all of their assets to qualify solely. So you just have to know the borrower and how they want to qualify and what they have available to either do asset or full doc. And then the isolated credit events are really nice because standard loans, they won't fit into a standard loan box because you have to meet certain waiting periods for, let's say, a bankruptcy, a foreclosure, short sale. In the isolated credit events for this particular program, as long as we can see that it came from just an isolated one time event, maybe it was a death in the family, a divorce, a natural disaster, something that precluded the borrower from paying, they have explanations. We can see that it was just isolated to this certain circumstance and they were making slowed payments or they have a 30-day or more delinquency. We analyze the whole picture of the loan and their whole entire payment history, what they've done in the past versus just this isolated event, and we can still look to qualify them and put them in maximize financing. So it's really nice because standard agency loans, you have to wait. You have to wait the 7 year, the 4 year, whatever period that is to even think about doing a loan.
Yeah. So what would be the percentage of down payment that's required for the Edge?
This one also works very similar to the SMART. So it just depends on your scenario. If you're starting at a lower credit score, you have a limit, a lower limit for loan amount. And typically you're between the 80 and 85% range. You can get to a higher range with a higher credit score up to 90. And then if you're doing second home or investment, depending on your loan amount again and credit score, you can be anywhere from 70% up to 85%. So again, it's depending on your loan amount and credit score that'll drive your factors of how much you can actually borrow.
Do we typically get our credit coach involved when we have borrowers in this situation?
Absolutely. So typically, our loan officers will send all the credit report information when they do see derogatory events to our credit coach. He'll look at it first and see if there's anything they can approve and improve or clean up before we send it off for underwriting. So that way, at least we've buttoned up everything possible. And he can also help to identify these truly are isolated credit events and help with that explanation and guiding the borrower for that.
And heck, sometimes he probably even improves the score to a different level based
Right,
on other
exactly.
situations that might be in the credit report. Okay. So I'm like, so Edge to me, I feel like it's like the second chance like scenario loan type of thing. Like everyone gets, that get out of the bunker, zone. So I think this one's really, really cool. And it's also like a tool for the agents. They can use that when they know that they're, maybe the buyer that they've been working with for a long time has had some situations and they just thought, they had to wait. Now maybe they don't, and get with our loan officer to figure out if they're now in a buying situation.
Yeah, these programs are absolutely essential to have in your arsenal because it reaches a vast audience and doesn't just pin you into one type of program of what the age like the industry standard is, what you consider to have to fit into a mold. So people that are artists, people that are musicians, people that, all their income reports on a 1099 can do the SMART. People with just assets can do the edge. People with these isolated credit events can do the edge. So it really widens that box of purchasing power for people and gives you a broader audience to market to when you take out to these properties.
Yeah, absolutely. What is it, the Shakespeare quote? Like, why are you trying to fit in when you were born to stand out? Like, we've got
It's
programs for
awesome.
that.
Yeah, we could call it the STM standout
That's
products.
right. That's right. We're always coming up with new names for our programs, right? It's perfect.
Exactly.
All right, so the next one is, oh goodness, the next one is our signature program, and this is huge. We have so many loan officers out there right now that this is their main product. How they're marketing it to their agents, how amazing it is for the borrowers. We especially in the second home market. I know it's available for primary residents too, but it seems to be very attractive to our second homes. And I know we in our markets we have a ton of second home options. So let's roll this one because this one's really good.
This one is near and dear to my heart. It was born about because, like you mentioned, our markets touch a lot of beachfront properties, oceanfront. And we have a lot of lending in South Carolina, North Carolina. So your Charleston, Myrtle Beach, Outer Banks, Wilmington, even Virginia Beach and Sandbridge, and the ocean front. So this one was really developed to touch a lot of those markets, but it also expands to any other second homes that you're looking at. So it doesn't have to be a beach property. I'm just an Outer Banks girl, so I love the Outer Banks, and
Yeah, I'm gonna
this
go
one.
ahead and get that second home in Snowshoe. That's I'm going there.
Exactly. That
Yes.
works for that as well. We had someone purchase in wintergreen, so it
Right.
definitely works for those as well. It's not just beach. I'm just a beach girl at heart. So, this was all driven by that and that desire to live at the beach full time. So, it's a second home that has primary pricing. So, when you're thinking about pricing a second home, typically any investor or agency you see, it's loaded with loan level pricing adjustments, meaning the rate is going to cost you more at the closing table than what it would on this product. This is going to fit into a regular, like if you're purchasing a primary home, it's not going to hit you with all those ancillary second home LLPAs because second homes are a riskier product. If a borrower is going to default, they would default on a second home before they would ever default on a first. So you don't have those LLPAs. There's room to go all the way up to jumbo limits. There's exceptions that can be made so because it's a portfolio product, so you have to think about the fact that we can find some things to like fit in in here that don't fit in the natural mold. Maybe your borrower's not taking occupancy of this house or using it for 90 days following closing. That's acceptable. Vacation rental addendums, that's a huge one in our market. So North Carolina has a law that a current seller selling their property, the purchaser has to honor a minimum of 180 days of current rents. So if that current seller is working with a property management team and they've rented that property out, the new purchaser has to honor at least 180 days following their closing. What typically our investors and agencies like to see, and we like to see as well, is nothing past that 180 days. It's law. We know they have to honor the 180 days, but in your vacation rental addendum that comes with the sales contract, it will actually typically show the rent dates to and from. We don't like to see it past the 180 days. If we do see it, we ask that that be corrected because it will indicate to us that the borrower's intention is to likely stay with that property management firm and continue to rent it. And then it becomes a question of if it's actually an investment property and not a
Mhm.
second home. So making sure that that vacation rental addendum has the start and stop dates of the rents, no more than 180 days following our closing, because you do want to be able to have that flexibility to occupy it for at least 4 months out of the year is typically what everyone's looking for. Making sure you can occupy the second home 4 months out of the year and you're able to use that home at your leisure and you're not restricted to any restrictions with a property management group.
So how long does someone really need to occupy the property to be a second home to make it a second home qualifier?
It's they say occupying, but it's not necessarily occupying. It's just being able to show that if you wanted to go down there for four
Mhm.
months out of the year, you have that availability. You really look at it more like it's not a timeshare per se, or you're not in a property management agreement that restricts your use at any time or
Mhm.
dictates when you can and can't use it. You have to be in control of when you can and can't use it and be able to block out 4 months out of the year in which you're able to utilize it and then rent it out the rest of the time.
Got it. Got it. Okay. So, and then you said some jumbo limits. This goes up to jumbo limits. What is our jumbo limits? I mean, based on different areas, right? But I mean, typically, how high is that?
806,500 is the conforming limit, so anything above that and up to 2 million. They'll do anything above that and up to 2 million. Our underwriters will review that and approve that as long as the reserves are there and the credit looks good. Typically when you're going above that conforming limit, we do want to see that you have a good number of reserves. And I would say that's typically at least 2 to 4 months worth of reserves. So being
Got it.
able to cover that second home and your primary mortgage for 2 to 4 months after closing.
That totally makes sense. Okay, so and then I had another question I wrote down when you were talking that I think is really neat. So when the vacation rental addendum, so when someone's putting their house on the market, they probably, if there was an investment property for them, they were using a property management group, all of that. So, and sometimes it's a deal breaker, right? So, because people, they don't want to rent it out, but this allows for them to still honor those renters that are coming in for their vacation, their special time, but it gets them, it doesn't knock their ability to get a loan. So that's really cool. That's
Exactly. Yeah, the vacation rental addendum it's a law. So most of the time, if anyone argues with you about it, or if you've heard other lenders or agencies say we can't take it, you just have to push back because it's something that no one can break. We can't tell the current seller, they have to cancel those rents. We just have to tell them we can't go over 180 days because we have to meet the law.
what is the like down payment requirements for this?
So these go all the way up to 90%, which is also out of the box. Typically, your second home, you're maxing your financing at 80. So the borrower is only putting down 10% on a second home. Your credit score minimums are 700. There are exceptions, of course, to any rule. So if you have a credit score a little under that, as long as they have the reserves there, we can look at that and see if it makes it worth their while as well. So don't always cap yourself at that. There's always the worst we can say is no. So just ask and let us analyze the borrower's profile and see if it makes sense to do the deal. But yeah, the fact that they go up to 90%, there's no LLPAs. We allow the vacation rental addendum with no issues. This really is a very smooth second home transaction that reaches a very wide audience of borrowers.
Yeah, that's awesome. So, agent friends, what I just heard from that is you definitely get with your loan officer and let's come up with some marketing that can really get some prospects in there for our summer buyers, our beach girls like Allison or even heck winter right now like me. So,
I see
all
golf
right.
carts going down through Sandbridge with ads and flyers and free koozies.
Absolutely. Absolutely. All right, so our next program let's talk about is the investment program. So I mean, like, you have your second homes, you've got your primaries, you've got all of these different niches that are out there that borrowers can actually use. But we also have investment. So I mean, investment's a tricky one. It's expensive, especially right now. So like, let's talk about our investment program and why this is different than what other people have out there.
So DSCR, so that everyone knows, is debt service coverage ratio. And what it is it's qualifying the borrower for purchasing a short-term or long-term rental investment property using the projected rental income. So when they go out to appraise the property, they're going to use the market analysis of comparables and see what the projected rental income would be for this property. Short terms get a little trickier, but they still can analyze this and tell you what the prospective rental income would be for this. So there's no personal income or employment information required from the borrower to qualify. You're simply qualifying off this collateral and what it's going to bring in rental wise for you. So this is a great way to acquire more investment properties without tapping into any of your liquidity and just being able to use the property itself, get it set up quickly. It's a fast close because you don't have all of that extra
Right.
income and employment documentation to analyze or things to explain. And it's just a effort to get you in somewhere that while the rate may always not be as low as what you would use to buy, primary home or a second home, it's a rate that's feasible to get you into investing. Maybe you want to start an LLC, you want to start investing in properties, renting them out. This is a great way to get yourself into that and become an investor and use that. It's going to take the net operating income of the debt obligations for the property and then include that debt payment against what the rental will be. And you should be able to qualify depending on that ratio to go all the way up to anywhere from 75 to 80%. And it's a 680 minimum credit score to get in the door. So it's very attractive to start investing.
Yeah, that's really cool. I mean, do we have a high percentage of those that we do regularly?
We've done quite a bit of them, and I think we've done that because of our market share. So we see a lot of it in South Carolina, some in the Maryland and Virginia areas, South Carolina. So it's really helpful if I hate to go back to the beach thing, but if you want to start investing in beach properties, we have had some in West Virginia, like out in the mountains, like you mentioned. They want to invest in. You want to start investing in ski rental properties. You want to invest in beach properties, and you want to use that so that you and your family can take trips there, but then you're also making income off of it, to pay it back and not be able
Sure.
to have to pay out of pocket for that property. So it's a really good way to get started with that.
I mean, we all know, right, that buying is a huge way to start building equity wealth. So, and like, it's an
Absolutely.
awesome idea. Perfect. All right. So, and now, because it is the week of FHLB, it came back out. So let's go. Let's talk about FHLB. Let's talk about all the amazing things that FHLB is great. And it has helped so many people and there's what, three programs now within the FHLB suite. So hit me.
Yeah, so FHLB added a new program last year. We'll talk about that, but first we'll tap on the ones that everyone is pretty familiar with, the first time home buyer and community partners. What's really cool about these programs is they're usually big bank programs, and we get to use them as a residential lender that's personally owned by our two owners of the company. And it's really great because we can give you that tailored customer service. We are always ready to answer our phones. So anybody that wants to tap into these funds, call us immediately because they go very quick. The first time
Quick.
home buyer can get you up to $17,500 for down payment and closing costs. The community partners get you up to $20,000 in down payment and closing costs. And then the workforce housing is $15,000. The two programs I mentioned, the first time home buyer and the community partners, they do have what we call a soft second. So it's a deferred 5-year lien. It's at 0%, but it only has to be paid back if the borrower refinances or moves. And typically, if they refinance, it can be resubordinated to their new mortgage. We just have to make sure that that's told to us so we can make sure to resubordinate that.
Mm-hmm.
Their qualifying income levels are at 80% or below of the area median income limit. So, for example, like in Virginia Beach, you're talking about somebody under 50,000 for household size. So, Wendy, if you and I lived in a household together and we made 50,000 or less together combined income, and there was no other income sources from anyone in the house, we would qualify if we were either first time or community partners. Community partners reaches a vast amount of people. It's all of our first responders. So our firefighters, our police officers, our teachers, nurses, and anyone who works at a health accredited organization. And this also includes veterans. And it's anyone that has worked in these fields or is retired, so active or
Oh,
retired from these fields, including anyone that literally works at the facility. So the admin at the fire department, the janitor at the hospital, anyone that works at any of these facilities or has worked there and is retired and prove they've worked there can apply for that community partners.
wow,
The
that's really cool. I did not know that. I thought it did have to be the nurse or or the firefighter, but I had no idea it could be the receptionist. It could be the admin. And that's great. I bet you a lot of people don't know that.
I really do think people do overlook that because the flyers are to grab like first responders,
Sure.
firefighters, police officers. But I do think a lot of people miss that. And our loan officers are really good about expanding on that when you call and inquire about it because we really go over that very thoroughly in our trainings and remind them of that continually. The workforce housing program, that's going to expand your pool of borrowers to borrowers with higher income limits. So again, an example in the Virginia Beach area, this is anyone making over 80% up to 120. So if Wendy and I were the only ones in the household and we made over $100,000, less than $110,000, we would be able to qualify. So again, it's household income. So everybody 18 or older that's going to reside in the property within the next 12 months making income has to be reported. We're going to look at that and make sure that you don't exceed the income limits. But if you happen to exceed first time home buyer or community partners, now we can put you in workforce housing, and that's still $15,000. The great part about this is you put it towards down payment and closing costs. And then if we use all of those and we still have some funds left over, let's say your seller's also giving you some closing cost assistance and you want to maximize that, we can take $1,000 up to $1,000 that's left over and use that to pay down your principal curtailment of your loan amount. So you're walking in with additional equity if we find that there's some leftover funds on the table that we can apply back to the loan amount and reduce that for you.
It is so good. That's so great. So with the state programs, the FHLB grants, like a lot of times people are, combining them, right? So there's even more ways that borrowers can just, I mean, what's the best one you've ever seen?
So Virginia Housing does very well with them, but we also offer Maryland housing, South Carolina housing, North Carolina housing, and you're able to piggyback all these together, which is crazy. It's like you get everything but a brand new car in your transaction, I think. And
But
you
don't
have
buy a car when you're going through the loan process.
a That's a great tip. That's a great tip. Our coach also says that, Dan Solis. So, yeah, don't buy a car until you sign your closing papers and you wait a
Right.
week later and then buy your car. It can wait, trust me. So, yeah, with the state bond programs, it's great because some of the state bond programs offer options for just true grants where they're not any kind of lien against you and you just qualify for the grant money. And then they also offer, similar to FHLB's first time home buyer and community partners, they offer that soft second. Don't be afraid of soft seconds. FHLB can always be your third. They are okay being in third. So if your state bond program, you get a first, you get a second soft lien from them, and then you get the FHLB coupled as your third. As long as the borrower knows they're likely going to occupy that property for 5 years, and in some cases state bond up to 10 or 15, they're just getting a ton of free money. They're getting money. They're walking into a home with equity already on top of equity they may have already been walking into based on the appraisal. So they're putting themselves in a really great position to build that generational wealth. They're getting free money that they don't really have to do a lot for other than provide their income documentation to
Right.
us and let us analyze it. But the only thing I would really caution with any of these is the time. Be really prepared because these agencies have to look at the borrower's income information. We look at it first, they look at it second. So we button it all up for them. We get it over to them clean, but they make the ultimate decision if those grant funds or those down payment
Sure.
assistance are awarded. So plan extra for that. I always say like at least 10 to 15 business days, give it that at minimum, just so you don't cut yourself short. We don't run up on the end of a contract expiring. Make the
Mm.
seller very aware, like, hey, this person's applying for this assistance. We have this going on, keeping them informed of the timelines. And so if everybody's communicating on the same page, these can go really well. We had one borrower that ended up getting like over $100,000 in financing help. They bought like
Gosh.
a $500,000 condo. They got $100,000. They walked in with immediate equity. They ended up getting extra credit at closing with some cash back just because there was a little bit left over and it made sense. So they were able to pay off a little bit of debt at closing. They got $100,000 in grants, walked in with equity. I mean, it really is a huge win for them, and that generational wealth, it's so helpful to get these borrowers out of the rental pool and into home ownership. And FHLB, part of it is the whole reason why a lot of these have soft seconds is it's keeping the borrowers in the home for a purpose. They want to drive out investors out of neighborhoods and rebuild these neighborhoods to become more primary ownership instead of investor concentrated.
Yeah, it's revitalizing communities. It's amazing, and it's getting people who, have that struggle getting into their first home, when market went crazy and just so many problems getting like people to contract. And this helps them It's amazing. It's so cool. And our loan officers, they know the product really, really well. So definitely get with your loan officer, prospect for some first time home buyers, look at some of the rental communities out there and see if there's some options to, do some direct campaigns to them and tell them, hey, you can get into a house instead of paying for the landlord's mortgage, let's pay yours. So very cool. Well, I think that is pretty much the gist of our some of our niche products. We have a ton of programs. Our arsenal of investors and products out there is so vast. The loan officers are completely knowledgeable of what's going on. They also have a wingman in Allison who is always answering the phone and helping the loan officers make sure that your buyers are getting the best deal out there and getting in the right financing that fits their needs. So I appreciate your time. And as we're getting into March, March is credit month. So we do have our credit coach joining us in March for our next virtual hangout that will go with technology in my favor. So that's going to be the end of March. We usually do these around the last week of every month. So join us for learning more about your credit, getting your buyers ready for contract and application, and making more money in the spring, right? Like that's let's do this. So, but anyway, Allison, thank you, thank you, thank you. I appreciate it. I always enjoy rapping with you, and I think these are so much fun. So, again, apologies to everyone yesterday, but hopefully you watch our video, and if you have any questions, everyone here at Southern Trust is available to help you out.
Thank you, Wendy, for
Appreciate
putting
you.
this on. See
All
everybody
right,
soon.
see ya. Bye.